and it comes down to an operating income of a lot less than usual, this is a sign that they are losing a competitive advantage here. So with major downgrades and the stock absolutely collapsing, going from $261 a share down to $126 a share, we can see through the chart that the COVID stimulus definitely benefited a company like Target, where 70% of the products that they sell is definitely consumer discretionary. And so now with stimulus off the table, a consumer going from goods to services and experiences, we're definitely seeing a reflection in Target stock. And so now I want to dive into Target, as I do think this is possibly a stock that a lot of people are looking at. And so let's try to get a fair value of what we should be paying for Target. So when we go through top line growth, we can see here that Target definitely was kind of stuck in this $70 billion of revenue. And then come 2020, take a look at the massive move it had, having a pretty significant spike here into, when we look at what historically the company has done in revenue, we can see through 2020 definitely had a historic bump here, which has come through nice on operating income until we get through 2022 and current year of 2023. Operating expenses are going up, selling, general, and administration is going up, and this is usually a sign of losing a competitive advantage. When you see these type of expenses exploding, and it comes down to an operating income of a lot less than usual, this is a sign that they are losing a competitive advantage here. Historically, the company does do between 8 to 10% EBITDA margins, and there's been a couple cases where we can see here it's been low single digits, and we're heading into that low single digits once again. And so what I want to do right now is give you a visualization of Walmart's chart over the last 5 years versus Target's chart. So Target's chart is in the red and Walmart's chart is in the black. And what we're seeing here is we're seeing more of a defensive company in a company like Walmart versus a cyclical company in a company like Target. Target does really well on consumer is strong and the economic backdrop is strong, where Walmart is just consistently growing and is definitely more of a defensive type stock here. We can see the drastic outperformance in Target versus Walmart through the COVID stimulus and through easy monetary policy. And now we're starting to see that shift completely change here. I think we have the steady growth in the tortoise that gets to the finish line, and we have the rapid growth of the rabbit that finally dies out when it gets closer to the finish line. But this doesn't mean that it's not a buy. So what we need to do today is really understand that Target does much better in a stronger economic backdrop, and depending on what you think is coming in the future, might hinder you on waiting on Target, or if it's a buy today, maybe you start nibbling. So a few things we want to talk about through Target's earnings here. It had very little traffic growth, very little comparable sales growth. But the good thing is they were able to get inventory levels down and more than a 25% reduction in discretionary categories, which was kind of the big knock on their last quarter. So they are trying to head in the right direction here, really focusing on getting inventory levels down, and the things that they can move and move quick is what they need to be putting on the shelves. So they did GAAP earnings of $2.05, which was a 4.8% decrease from $2.16 in 2022. A couple other things we have to highlight is in the earnings call, they do expect shrink to be a big problem in profitability, and more than $500 million compared to last year. And so mixed. So this is pretty interesting because we're seeing a lot of companies go to the digital register and check yourself out type of registers. And I'm wondering if this is starting to have an impact now as things are getting tighter for the consumer. Digital sales were down 3.4%. And I don't think this is anything to do with the company. As I stated before, I think this is more to do with just where the consumer's priorities are currently. So while gross margins did expand slightly, we see here that operating income margins did come down. And that has to do with the SG&A going up, the tax rate being bumped up a little bit, and therefore when it comes down to operating income, it's a slight decrease. But this is something we want to keep an eye on. This very low margin business, and they have to execute almost with perfection to keep margins stabilized here. So that's the concern I have with Target is, I definitely think top line revenue will be there, even if it's a slight decline. The concern I have with the company is going to be margins and inventory levels. We see here after tax invested capital return was roughly 11.4%, which is still pretty strong. But when you compare it to 25%, obviously not so strong. But we have to remember the type of economic backdrop we were in. And guys, this is what I've been talking about on the channel. I think a lot of people think I've been pessimistic on the channel. That's not the case. We are seeing massive divergences in the consumer and what is going on with individual company run businesses. When we compare companies like Dollar Tree versus Dollar General, Walmart versus a Target, everything was going up during the pandemic, and now it's about quality and what is actually going to have sustainable margins and top line revenue growth. And we're starting to see this disparity take place. So when we go line item here, we can see that top line revenue basically stayed flat, going up roughly 0.5%. But the problem is what? Sales, general, and administration skyrocketed. Now, if we start seeing this come down and we see sales still maintaining some sort of slow growth here, I really like that. So this is definitely going to be a question of how strong the consumer can maintain through a liquidity crunch, and can we get margin expansion by the business running more efficiently? Can they control shrinkage? And they still have the option to buy back shares of roughly 9 billion left. So we could see share repurchases if the stock keeps tanking to stabilize stock prices here. So let's talk about guidance really quick before we plug in our numbers. So they're planning for a wide range of sales outcome centered around a low single-digit decline here. And this is why the stock is obviously being repriced here. We have a lot of problems within Target internally that we're starting to see get fixed in companies like Walmart. Now, Target is basically based on consumer discretion, but they do have some consumer staples there. And when I think about shopping, I'm thinking about Costco and Walmart. So I don't even necessarily go to Target for more of your consumer staples aspect. And I don't know if that applies for everybody else, but I tend to go into Target for the consumer discretion side, and then I possibly look at consumer staple side when I get in there. And so that's why I lean more towards this being heavily cyclical and depending on the economic backdrop. So if we're thinking deep recession, I think this hurts Target immensely. And if we're thinking deep recession, I think this benefits Walmart and Costco's. So I'm being extremely conservative here just to protect me, because I just don't know what the next 3 years are going to bring. We know that over the next year, they're going to have negative single-digit returns, and I've priced that in at 2023, basically going from 109 million in revenue to back down to about 107 in revenue, 2024, 108, and then we start getting a little bit of growth in 3 to 6 years and 6 to 10 years, and I'm being very comfortable here with 1 to 2% revenue growth. I definitely think they can achieve above and beyond that going out 3 to 5 years, but I'm building safety in a couple different ways here. I think they can do 3 to 5% revenue growth from 6 to 10 years, especially if they're becoming more efficient. We talk about more digital, direct-to-consumer type sales taking place here. And then I'm using a required rate of return of 12% as well. So I'm undershooting what I think they can do for growth, but I'm also adding a buffer here of trying to get 12% rate of return. So if I were to get in this stock, I think I would be comfortable getting in at the prices that I'm going to show you. EBITDA margins are sitting around 5. We're going to keep them around 5 for the next 1 to 3 years, bump it up to 6 from 3 to 6, and then bump it up to 8 from 6 to 10. We've seen them do between 8 to 10%, and I tend to think they will get back on this track, especially with inventory levels getting down and a stronger economic backdrop. They have been buying back shares, but I'm going to put 0%, once again, building a little bit of safety here in case they are not buying back shares because of the financial stress that the company might go through in the next few years. When we look at an EV to EBITDA, we can see here they basically trade at 11.5 versus the peers a little over 13. Over the last few years, it's definitely had an inflated multiple, and somewhere in the middle is probably the truth. And so I'm going to use between a 12 to 14 EV to EBITDA, which is in line with their peers. I'm using a EV to EBITDA of a 13. We have a free cash flow standpoint at around $111 to $100 a share. And when we use a multiple of EV to EBITDA and annualizing out their earnings power, free cash flow, balance sheet, basically get an enterprise value of roughly $127 billion, call it $128 billion. And when we bring it down to a per share basis, that gets us a $92 to $93 share price, averaging out basically between $95 to $100 is where I'd be looking at possibly starting to build a position in a company like Target. and it's at 127 right now, recently been downgraded, and the chart is pretty ugly overall. So I do think there is an opportunity to possibly reach on target between that 95 to 110 mark, which would only be about, another 8 to 10% decline here. And I get a fair price target of 2031 at $257.55. Now, of course, this is just me running my analysis. Obviously, you have to do your own due diligence. This is not financial advice, but this is just my process to kind of figure out, if I ignore the noise and I put my expectation on the company, where should I be getting in and where should I be getting out, or what should my expectations be? And as they drop quarterly reports, I need to be updating this to make sure that the numbers are actually making sense. Because if they start growing at 4 and 5%, well, most likely I'm not going to get in at these prices, right? I'll have to reach a little bit higher. So as always, guys, appreciate your time. Thank you so much for spending it with me, and we will see you in the next one. Peace.